Good evening, everyone, and welcome to the Mayor's Office of Economic Development Center's Restaurant Resiliency Workshop, Employment Law. My name is Demarius Stoops. I'm one of the 6 neighborhood business managers that cover primarily neighborhoods throughout the city of Boston and Boston Main Streets. I'm joined today by our CommonWealth Kitchen leadership group, Jessica Collin, Roz Freeman, Irene Lee, and our Toast member, Kim Pederzani. So wanted to take the opportunity to turn it over to Jessica and welcome everyone.
Thank you so much. Hello, everyone, and welcome again. Huge thank you to the City of Boston for hosting us this evening. My name is Jessica Coughlin, and I'm the Director of Development at CommonWealth Kitchen. CommonWealth Kitchen is Greater Boston's nonprofit food business incubator. We're located in the Grove Hall neighborhood of Dorchester, and we work with packaged goods companies, bakers, beverage makers, food trucks, and now restaurants. Our Restaurant Resiliency Initiative is a pilot program working with a wonderful cohort of Black and Latinx-owned restaurants to grow their businesses in a post-COVID Boston. We're also providing resources to the broader food community, like this series of webinars in partnership with the City of Boston. We're thrilled to have Toast joining us for this presentation tonight. Toast is an all-in-one restaurant point of sale company headquartered in Boston, and they've been our technology partner for this program. Kim Pederzani is the compliance manager at Toast, and she's joined by our Restaurant Resiliency Program Manager, Irene Lee of Maymay Restaurant, and Roz Freeman, Director of Entrepreneurship at CommonWealth Kitchen. So thank you all so much for being here this evening, and I'll pass it on to you, Irene.
Okay, so many introductions. Hi, everyone. Thank you so much for joining us. I'm really excited to be able to have Kim with us today. Employment law, speaking from my own experience as a restaurant owner, is one of those scary things that sometimes you don't even want to ask questions about because you feel like you're already supposed to know it. That was definitely me and probably still me. And so you're going to hear me asking Kim a lot of questions tonight that I should probably already know the answer to. So let's just say, for argument's sake, that I am asking these questions rhetorically, but we do hope to hear from all of you as well during the webinar. So please feel free to put items in the chat or the question and answer. We'll try to take questions during the course of the webinar if they're relevant to the immediate point, and then we'll probably save some for the end. As follow-up, we are going to send everyone a survey regarding the webinar to hear from you and to think about next steps if you need further support. So without any more ado, I'll hand it over to Kim. Thanks so much.
All righty, cool beans. So good evening, everyone. Welcome to our discussion of employment tax and business considerations. My name is Kim Pederzani. I'm the compliance manager for the Employee Cloud business line at Toast. I specialize in ensuring that the payroll and tax components of our software are built and maintained in alignment with governing federal, state, and local rules and regulations. That basically makes me a big old nerd. So today what we're going to be talking about is we're going to talk about some of the considerations that employers look at when they're evaluating their business practices and procedures to fulfill their duties as an employer. So we're going to try and go over as many components that we can. So we'll hopefully be able to touch on all of them today. Now, before we jump into the nitty-gritty details, it is important to note that the information I'm going to discuss today is not intended as any kind of legal, financial, tax, or other professional advice geared towards any particular employer or their business. If you have questions about what steps or actions are most appropriate for you or your circumstances or your business, I cannot stress this enough. Please contact a licensed professional to assist you. So based on the feedback that we received, we're going to be hitting on some of the most requested topics. We're going to start off discussing what worker classification is, what it looks like from a business perspective when classifying a worker as an employee as opposed to an independent contractor. Next, we're going to dive into what the dreaded federal income tax obligations look like, and we're going to go over that at a high level. Following that, we're going to jump into Massachusetts and see how the tax obligations in the state interact and differ with respect to the federal obligations. And finally, we're going to finish off by discussing tip requirements and how employers generally manage that kind of element. As Irene said, we're going to try and also reserve a few minutes at the end to address any kind of questions that pop up. And if you, like Irene said, if there are any questions, please submit them through the chat feature. So let's see here. Well, let's go ahead and dive in. All right, worker classification. So worker classification is what I like to call the easiest step into the rabbit hole of employer concerns. So what starts off as a simple designation can easily devolve into problems with state wage and hour departments, issues with the Departments of Labor, of course, issues with the IRS, amongst other things, which is all the more reason to fully understand the duties and responsibilities that employers undertake when classifying their employees or their workers. Today, we're going to talk about the two major categories of workers, employees and independent contractors. So let's go ahead and dive in. Let's see. Now, before we begin just exploring the differences between these two types of workers, let's begin by discussing some of the reasons that employers choose one or the other. An employer might choose to classify a worker as an employee because they want to provide their workers with things like benefits, health insurance, PTO, etc. They might want to handle the taxes on behalf of their employees, or they might have an advisor who tells them it's more appropriate to categorize a worker as an employee than an independent contractor. Alternatively, an employer might classify a worker as an independent contractor because, well, let's be honest, it's a lot cheaper to do so. They might not be able to provide benefits to workers, or maybe the worker legitimately is an independent contractor. The point is that there's a multitude of reasons why any employer chooses one classification over another. Both come with their own workflow and requirements. However, the important distinction, and for that matter, how the powers that be determine whether a worker is properly classified is found by looking at the bigger picture of how an employer interacts with the worker. Sorry, one moment on the counter, on the island. My apologies. So, let me go back. Okay, employers might choose to classify their workers as employees because, oh, I already talked about that. So when the IRS is trying to determine whether or not somebody is an employee or an independent contractor, you think it'd be as easy as looking at the definition, but there's actually no hard and fast definition of what an employee actually is. Instead, things come down to money. And what I mean by that is that the IRS wants to know how a worker should be taxed. Are they being taxed to their employer, or is the worker responsible for their own taxes? So in turn, the IRS works to ascertain this worker status by asking the very long-winded question of who is in control of the relationship. Now, it's a tough question to answer. So to do this, the IRS looks at a few different types of control that dictate the employment. They are behavioral control, financial control, and what does this relationship between the parties actually look like? So let's start off with behavioral control. Behavioral control refers to who's in charge and how that person in charge is directing the worker's performance. So when the IRS is looking at who has control over the behavior of the worker, and by behavior, I mean work performance, the IRS is looking at interactions such as the level of the instruction given to the worker. Generally, an employee is given more specific instructions than an independent contractor about how to complete their work. They also look at what kind of training is available. Usually, a company will provide various types of training to their employees on a lot of different types of subject matter, like policies and procedures, HR stuff, that kind of thing, for general workflow. But independent contractors are generally not recipients of trainings and are generally hired to perform a specific task with the expectation that they should rely on their own knowledge and skills to perform the actual task. So that's a little bit about behavioral control. Let's talk about financial control. So financial control refers to who gets to play a part in the financial components of a worker's performance. The IRS generally looks at factors like reimbursement of business expenses, Usually an independent contractor will have business expenses that are not reimbursed, but an employee will. What kind of investment does the worker have in their performance? Let's use an example. Let's say that we have an employee who has a broken down truck that he uses for work. Usually an employee probably doesn't care as much about a work truck because they're utilizing it and something happens to it, the employer is the one who pays to fix it. But an independent contractor probably cares a lot more about the work truck because they're responsible for fixing it if it breaks down. Now, let's also talk about who can access the worker's services. So generally, an employee works to perform a specific job for the employer, but an independent contractor generally works for multiple employers at the same time. They also ask, how does the worker actually get paid? Usually, an independent contractor their pay is determined by the job that they're completing for the employer. But an employee is usually paid on a periodic basis, so like weekly, bi-weekly, etc. Finally, the IRS is asking who's ultimately going to make or lose money based on this performance. Usually, an independent contractor takes on a job because they want them to make a profit from it. However, usually an employee performs work that will profit the employer, and then the employer will turn around and compensate the employee in some manner. That was a lot of stuff so far, so tell me if I'm going too fast.
Kim, I think it would be great just to remind folks that contractors receive 1099s, right?
Correct, they do.
And employees receive W-2s. And I think I've heard people kind of use those terms like interchangeably or like as shorthand. So sometimes you'll hear the phrase 1099 contractor, and that's just specifying. But so if folks are talking to their lawyers or even to their employees who want to understand the implications on their taxes, those are some of the phrases that might come up.
That's a very, very good point. Usually when referring to an independent contractor, sometimes people will say a 1099 employee. It's the same thing. So employees generally are the recipients of a W-2 instead. So that's a very important distinction to make when talking to an advisor. So let's jump into some of the type of relationship characteristics that the IRS will look at in trying to evaluate whether someone's an employee or an independent contractor or a 1099 employee. So they'll look at the agreement that was in place between the parties. Usually an agreement is pretty consistent in spelling out the relationship. So-and-so is the employer, so-and-so is the employee or being employed by. They also ask if the employer providing benefits to the worker. Usually an employer might offer perks like health insurance or sick pay to an employee, but not to an independent contractor. They want to know how long this relationship has been. An independent contractor is usually working for the employer for a specific period of time or for a project, but an employee is usually working indefinitely. And finally, is this work normally part of the day-to-day operations of the employer's business? Or is this an outlier? So a lot just depends. All of these factors, when looked at collectively from a very high level, are generally pretty indicative of whether a worker is or is not an employee based on the factors of the job itself, and instead of how the employer has actually represented the relationship. It's also important to note that the employer may have a very good reason for categorizing an employee the way they have, categorizing a worker the way that they have. Every job is different, and what's important is to understand the implication of categorizing a worker in one way or another, because getting it wrong can be very costly. Most employers who misclassify their workers don't anticipate or know of the long-reaching effects of doing so. There's huge penalties for not withholding income tax, for failing to file reports and tax returns. There's opportunities for investigations by the IRS, the Department of Labor, state labor departments, among so many others. And it can result in an absolutely huge financial implication down the road. And all this is probably why it's one of the top 5 most expensive issues that I see. That's why I always say that it's a lot better to spend a couple $100s on an advisor and have the right answer than to spend hundreds of thousands of dollars gambling on an assumption. So that's pretty much a synopsis of worker classification. Are there any questions before we move forward into taxes? I know everyone's itching too.
I have a question, Kim. So it seems like, based on what you have said, most people doing kind of like cook or server functions probably don't qualify as a 1099 employee. I mean, obviously there are specifics to each situation, but my understanding is that most sort of standard functions in a restaurant would be a W-2 employee. Is that right?
Correct. For the most part, if someone is acting as an employee, they generally are an employee. And usually the the IRS will err on the side of what is most favorable to that individual. So in like an audit or an investigation, that's what the IRS is really kind of looking at. What's going to be best for this person as opposed to what's best for the employee or employer.
Right. I also had a question that someone asked me about insurance implications. So for like workers' compensation covering an employee getting hurt at work, does insurance cover 1099s and W-2s typically?
It depends on the insurance.
Right.
Usually my recommendation is to talk to the broker about the insurance policy itself. So I do generally say, make sure that that's one thing that you want to shore up really, really carefully with regards to classification, because there's huge implications. If you get hurt on the job and, you go to your employer and expect some sort of workers' comp and you find out, hey, I'm an independent contractor, that can lead into an investigation with different labor boards, et cetera. And it can spiral downward from there.
Yeah. And I think the last question I have on this for the moment is, we do work with a lot of businesses that are truly family affairs. So, mom comes in on the weekend, my cousin comes and helps in the front of house on her days off. And I think sometimes we don't classify these folks at all. And so it sounds like there are probably a lot of reasons to kind of try to have formal relationships for those arrangements. Especially if something happens, like there is an audit or there is an accident of some sort.
Absolutely. It's always a good thing to make sure that you have your relationships clear and documented. Because for that reason, if you ever come back in an audit or something and the IRS asks, okay, well, why is this person getting this amount? Or why did you report taxes for this person for this amount? You want to have a clear explanation you want to be able to answer to.
Awesome. Thank you, Kim. Roz, anything from you?
Well, I guess I'm just curious. I do know some people who might be in the situation of having misclassified a worker, like have 1099s working as a prep cook in the kitchen. What's like the high level process that they should go through if they decide they want to change someone at this point?
So that is a very, very big question. We may not have time to fully answer it right now, but we can probably follow up later on it just because it gets a little complex.
Yeah, or I even mean just like step one, like who's the first person you should call? Like not even the whole process, but like what's the first step someone should take?
Your advisor.
Your advisor, okay.
Yeah,
okay.
Yeah. So, but that's generally my go-to for everything, so. Okay, let's go ahead and jump into income taxes. So when people think of federal income taxes, they generally assume that the big bad IRS is going to come get their business. They're going to blow all their company's profits away. So federal income tax is inherently complicated. And when envisioning the repercussions of making an incorrect tax decision, the concerns become exacerbated because nobody wants to make a mistake that's going to land their business in jeopardy. So let's try and break down some of these federal components so they're not so complicated and see how successful employers navigate the fulfillment of those obligations. So one of the employer's primary obligations is to ensure that they're deducting and withholding federal income taxes from the wages that they're paying to their workers. The employer then must remit or send over those withheld amounts to the government periodically and report on them. So at the end of the year, the employer can provide an approximation of what an employee's income tax liability looks like based on the information the employer has available to them. That's obviously easier said than done. So let's begin by breaking down some of the most prevalent types of federal income withholdings. So today, in the federal income tax component, we're going to talk a little bit about three major taxes that employers deal with: federal income tax, Social Security and Medicare taxes, or FICA taxes as they're commonly referred to, and federal unemployment taxes. So let's start off with federal income tax. Federal income tax is an amount that's withheld from an employee's wage payment and calculated based off of the information contained in an employee's withholding certificate. Employers can choose from a few different methods when calculating the amount of federal income tax to withhold, but the most popular are generally the percentage method and the wage bracket method. But before we kind of jump into those, let's talk a little bit about withholding certificates, because those are kind of a biggie. A withholding certificate is where the employer provides certain information like marital status, dependents, and other information to the employer. The forms are generally filled out at hire, but occasionally they'll be updated when an employee's circumstances change or when it becomes otherwise necessary to do so. That can be, a new baby or a new job, etc. In any case, when the information is obtained, the employer then cross-references the employee data given in the employee data given and the employment data, such as like pay periods in a year and the annual income of the employee, against federal calculation methods to determine approximately how much of an employee is going to owe in federal income tax based on the employee's work and life circumstances. So that is basically the W-4. There are state versions of that, which we'll talk about in a little bit later on when we get into the state tax components. Let's talk a little bit about Social Security and Medicare taxes, which are, again, sometimes referred to as FICA taxes. And despite them being referred to together, there are separate forms of income withholding than the federal income tax that we just discussed. So there's two very, very big differences between FICA withholding and federal income tax withholding that we, again, just discussed. Federal income tax is generally an amount that's, while it's being withheld from wages by the employer, is ultimately paid for by the employee. FICA differs because usually the employer will withhold the taxes, but the taxes are shared by the employee and the employer. Another important distinction is that there's a broader range of payments to employees that are not subject to FICA. So generally an employee will earn conventional pay for work performed, and those wages are subject to FICA withholding. But occasionally an employee will receive compensation in the forms of like dependent care assistance, HSAs, de minimis benefits, meals, which are not necessarily subject to FICA. So let's talk a little bit about the Social Security tax portion first. Social Security tax is calculated against the employee's wages up to a certain amount. So once that threshold is reached, Social Security taxes are no longer calculated against the wages beyond that point. Currently, the Social Security tax rate is at 6.2%. So that is 6.2% for the employee and 6.2% for the employer. And the wage threshold is currently at $142,800 for 2021. Now, alternatively, the Medicare tax portion does not have a wage threshold. So calculation is against the entirety of the employee's wages. However, after a certain amount of income, an additional Medicare tax is assessed. The Medicare tax rate is currently at 1.45%. And again, that's 1.45 for the employee and 1.45 for the employer. So it comes out to 15.3% in FICA contributions for the employer and the employee. FUTA. Lovely, lovely FUTA. So federal unemployment tax, also known as FUTA, is a tax that provides payments of unemployment compensation to workers who have lost their jobs. Majority of the time, an employer is going to pay both federal and state unemployment taxes, though the amounts and subjectivity depend on the jurisdiction. So we will address the state portion of the unemployment taxes a little bit later on in this presentation, but for right now, we're going to go over the federal unemployment portion. Not every employer is required to pay FUTA. However, the majority of employers are required to pay. So we're going to focus on what that obligation looks like for those employers. The FUTA rate is currently at 6%, and FUTA is taxed. The FUTA tax is assessed on the first $7,000 of each employee's annual wages. Despite the percentage, the majority of employers do not actually pay the full 6% of FUTA. Generally, if an employer pays their state unemployment taxes on time and in the complete amount, the employer can receive a FUTA tax credit of up to 5.4% of FUTA, depending on the jurisdiction. So it really comes out looking like an employer could, in some cases, pay 0.6% of FUTA. So what does this actually look like for an employer? Let's talk through a scenario. Let's say I'm employer A and I have 50 employees. We're going to first look at what my FUTA would cost if I had 0 credit. So if my FUTA tax rate is 6% on the first $7,000 in earnings for all my employees, I would multiply the $7,000 by 6%, which would equal $420. This is the amount that I have to pay for each employee. I would then multiply that amount by the amount of employees I have, which is 50, and I end up paying $21,000 in total for all of my employees in FUTA, which I don't know about you, but I'd much rather spend that kind of money on chocolate and wine. Now, let's say it's the same situation, but this time I have a tax credit because I always pay my standard unemployment payments in full and on time. So this time I begin by multiplying, before I begin multiplying, I subtract my FUTA tax credit from my FUTA tax rate. So in other words, I subtract 5.4% from my original 6% to end up with 0.6%. I then multiply $7,000 by 0.6%, again, instead of 6%, and I'm now paying $42 per employee in FUTA. When I multiply that amount by all of my employees, all 50 of them, I'm now paying $2,100 in FUTA against the original $21,000 I would have paid without the tax credit. Again, a lot more money for chocolate and wine.
Thanks, Kim. Kim, I'm curious on these 3 different areas that you just touched on. If someone's like panicking because they haven't yet dealt with this stuff, but they do work with a payroll company and accountant, how likely is it that that stuff is already being dealt with, or what should they do to figure out whether or not they are already taking care of these things that you're talking about?
That's a really good question. So generally what I would recommend is to reach out to your payroll provider and really get that clarification. You know, ask those questions. Hey, what are you handling? How are you handling it? What does this look like? If you're using an advisor, I'd ask the same questions. You know, everyone should have a complete understanding of what their finances for their business are going to look like and who's going to be in charge of those obligations. Because usually it comes back on the employer to make sure that they are.
Awesome. Cool. And for that FUTA one that you just touched on, is that something, how common is it that an accountant is already taking account for that tax credit? Because that seems like an easy win for a bunch of money. Is that commonly already taken care of, or is that something that someone has to proactively ask about?
Generally, it's usually taken care of.
Okay, great.
So I can't speak for every payroll company out there, but I can say that generally it is.
Awesome. Thank you.
No problem. So employers will generally calculate their FUTA liability quarterly for 2 reasons. One, so that they can ensure they're going to obtain the full FUTA tax credit for the year, which again, max of 5.4%, and it makes a huge difference. And 2, to ensure that they're depositing the required amounts for the quarter. So what does this actually look like in a real life scenario? Let's use our last example. So as a reminder, I'm employer A, and I have 50 employees working for me. And we're going to use today's date, which is April 27th. And let's say that I want to determine whether or not I need to deposit any FUTA taxes for the first quarter of 2021. So as shown in the previous slide, the first quarter of the year runs from January 1st through March 31st. And the federal deadline to deposit applicable FUTA taxes is on April 30th, which is obviously in a few days from now, so I need to work quickly. So the first thing that I'm going to do is I'm going to determine what my FUTA taxable wages are for the quarter for my employees. how I'm going to be doing that is I'm going to be taking a look at my employees' earnings for the quarter as a whole up to $7,000. So if I'm looking at my employee Barry's wages for the quarter, and I see that he's earned $4,000 during the quarter, I'd calculate my food and tax rate against that $4,000. And that sounds reminiscent of high school, so let's visualize it with him first. So again, Barry made $4,000 in food earnings for the quarter. I'm going to multiply that by the reduced tax rate, which again is 0.6%. And I end up with $24 in food and taxes that I need to deposit with the federal government. But let's throw a wrench in the mix. So I've calculated the food amount I owe for Barry, but what about for all of my employees? So let's take a look. Let's assume that all of my employees together, Barry included, earn $100,000 in food earnings for the first quarter. Again, I'm going to multiply that $100,000 in earnings by my reduced tax rate of 0.6%, and I come out to $600 in food and taxes that I need to deposit with the federal government. But now that I've calculated the food and taxes I've owed, I've triggered another obligation. I have to actually deposit them on time and correctly. The federal government requires that if an employer owes more than $500 in food and taxes in a quarter, the full amount has to be deposited by the last day of the month following the end of the quarter. So in this case, I'm calculating my food and taxes for the first quarter. If I owe more than $500 in food and taxes for the quarter, I have to deposit the full amount I owe by April 30th so that I can deposit these food and taxes on time. Because I owe $600 in food and taxes for the quarter, as seen here, I have to deposit the full $600 amount with the federal government by April 30th. But if I don't have $500 in withholding, let's say I only owe $300 in food and taxes for the quarter instead. That amount is carried forward and added to the next quarter when I calculate that quarter's liability. So if I'm calculating my second quarter's food and taxes and it comes out to $400 for the second quarter, I would just add in the first quarter's $300, and now I owe $700 in food and taxes. Because the $700 amount is more than $500 for the second quarter, to be timely, I need to deposit the full $700 amount with the federal government by that deadline, which is July 31st. Now the fourth quarter is a little different. When calculating any food due for the fourth quarter, the employer determines what amount of food credit they are eligible for. In our scenario, it's 5.4%, and how much the total food tax balance is for the duration of the year. If the total amount due, so amount that I haven't actually deposited yet with the federal government, is more than $500, I have to deposit the full amount remaining by January 31st. If the total remaining amount due is less than $500, I can deposit the remaining amount with my Form 940 that I filed by January 31st. So that was a lot of fun in federal taxes. Are there any kind of questions before we move into the state portion? All right.
Very good. Thank you.
So let's jump over to Massachusetts. Massachusetts currently has 4 types of income withholding obligations that employers should really be aware of. State income tax withholding, family leave insurance, state unemployment insurance, and workers' compensation. Today, we're going to go over the first 3. So state income tax withholding, family leave insurance, and state unemployment insurance. So Massachusetts operates pretty similarly to the federal government in terms of income tax obligations. Employers in Massachusetts are responsible for withholding state income taxes from employee wages and depositing those withheld funds with the Department of Revenue for the state. Also similar to withholding federal income taxes, an employer in Massachusetts needs to use either federal or state withholding certificate to ascertain the information that they need to calculate the approximate state income tax owed by their employees. In Massachusetts, employees will withhold state income tax from employees on each pay period, even when an employee doesn't actually work the full period. And just like with the federal income tax, employers can either use a percentage or a wage bracket method in addition to others to calculate the appropriate tax liability. But the difference is that the tables come from the state instead of the federal government. based on the amount of taxes withheld annually, each employer is then assigned a depositing schedule with both a corresponding deadline to deposit taxes in the form that will accompany the actual deposit. Now, Massachusetts this should say medical and family leave program. That's a typo on my part, so my apologies. So Massachusetts FMLA provides an insurance program for covered employees to receive family medical leave benefits. So when they take time away from work for a health condition, a family member's health condition, birth of a child, adopting or fostering a child, assisting with health or other matters stemming from a family's military service. Employees and employers pay the Massachusetts Family and Medical Leave taxes on wages up to the federal Social Security wage base, which is, again, $142,800. However, employers are responsible for paying any part of the Massachusetts FMLA taxes that are not withheld from employees. So again, a very important reason to make sure you're classifying your employees correctly, because this is another thing that could come back to bite you. Currently, the initial tax rate of Massachusetts FMLA is 0.75% of taxable wages. That's composed of 0.62% of medical leave contribution and 0.13% of family leave contribution. Employers are responsible for paying 60% of medical leave contributions, or 0.372% of taxable wages. And employees are responsible for the remaining 40% of the medical leave contribution, or 0.248% of taxable wages. However, employers are able to withhold up to 100% of family leave contributions from employees. However, there are exceptions. An employer who has fewer than 25 covered employees does not have to pay the employer portion of the medical leave contribution. So what that means is that the employee would be paying the medical leave contribution portion of 0.248% of taxable wages and the 0.13% of family leave contribution taxable wages. The employer would still remit those contributions on behalf of the employee, they just wouldn't have to pay them. So to be eligible for Massachusetts FMLA, an employee has to be covered employee. They have to meet financial eligibility requirements for unemployment benefits. That means that they need to be able to, or must be paid at least 30 times the weekly unemployment benefit that they'd be eligible to receive within the previous 12 months. And those wages have to come from an employer in Massachusetts. The benefits provided are payable at 80% of the employee's average weekly wage for the portion of the wage that's up to 50% of the state's average weekly wage and 50% of the employee's average weekly wage for the portion of the wage that is more than 50% of the state weekly wage, which I feel like I said that very, very quickly. So, however, essentially, the initial maximum weekly benefit is currently at $850, but it's adjusted every October 1st. So depending on the reasons for the leave period can range anywhere from a maximum of 12 to 26 weeks in a year, depending on the circumstances for the leave.
Kim, I have a quick question just about for restaurants under 25 employees, which I know many of the small restaurants that we work with are. Even though the employer is not required to put in their own portion of the FMLA contribution, does the employee still get the same benefit that they would if they were at a larger company?
That's a very good question. Let me confirm, because I always like to confirm if I don't know an answer right off the top of my head, but I believe yes. I believe that remains the same. However, I'll double check on that and follow up in the follow-up.
Okay, awesome, thank you.
No problem. So Massachusetts state unemployment insurance is a lot like the federal unemployment insurance. The difference is the jurisdiction that it applies to. Massachusetts unemployment insurance applies to all employees who are covered by FUTA, but to get into the particulars a little bit, employers are covered by state unemployment insurance if they pay wages of at least $1,500 in a 3-month quarter, if they employ at least one worker for some part of a day, that's full-time and part-time workers in each of 14 weeks in a year, if they acquire the business or part of the business of an employer who is subject to unemployment taxes, if they operate as a nonprofit organization that's exempt from federal income tax, involved in religious, charitable, educational, or other type of work whose total I always screw this word up, remuneration is less than $50 per quarter, or if they pay agricultural workers at least $40,000 in cash wages in a 3-month quarter, or employ at least 10 agricultural workers for some part of a day, again, full-time and part-time, in 20 weeks out of a year. All services for wages are performed, are full-time or part-time, like I said, are subject to unemployment insurance compensation taxes. However, this applies to employees and not necessarily independent contractors. But again, quickly jumping back to our discussion of worker classification, it's very, very good to know what type of worker you are so as to not get this incorrect. Employers are taxed on wages paid to each employee up to an annual wage base. For 2021, that wage base is $15,000. And the tax rate for the most seasoned employers is found in Schedule E. It ranges from 0.94% to 5.24% for positive rated employers, and 7.03% to 14.37% for negative rated employers. Amounts earned outside of the $15,000, though, are exempt. Experienced employers are also required to deposit a surcharge that helps to fund interest payments for loans for the federal unemployment account. Right now, that surcharge is 0.01% to 0.565% for positive rated employers, and 0.58% to 0.76% for negative rated employers. There are additional rates that can be assessed that relate to medical assistance and health insurance, but for the sake of time, we're not going to jump into those today. So let's see here. Any questions before we jump into tips?
Kim, I would love to just say quickly that, you know, the stuff about federal and state obligations can feel pretty dry and specific. And I just want to underscore that I think it's really important for business owners to at least have a sense of what's going on, because if you ever get into trouble for it, it can be really expensive. And I also think it's important for employers to be able to advocate for their staff, whether that is helping them access paid leave or unemployment, or even just explaining to them that, you know, it's not just the staff member who pays taxes on the income, like the employer pays taxes too. And I think all of those kind of little like kernels of information can be really helpful in building a team that really understands how the business works. So thank you very much for that.
Well said, and I completely agree. I think it's important that everyone is aware of the financial, you know, ongoings, whether they're an employee or they're an employer, and it all eventually, you know, it goes into the same pot of the IRS. But it is really important that everybody's aware of what's going on. So let's jump over to tips real quick. So tips are a form of gratuity that a customer voluntarily provides in recognition of services performed by a worker. So while tips are themselves not a new subject, over the years, the parameters of dealing with tips and other forms of gratuities have spelled out additional obligations for employers. Yay. So today we're going to talk through some of the major tip considerations that employers usually deal with, which are tip credits and tip pools. So where tip credits are permitted, an employer can take a tip credit against minimum wage payment obligations to a tipped employee based on the tips that the employee receives and retains. Where there's federal minimum wage, an employer is required to pay the federal minimum wage rate of $7.25 per hour. But of that, of that $7.25, up to $5.12 can be credited by being paid in tips. So let's run through an example for the state of Massachusetts. Now in the state of Massachusetts, the minimum wage rate is currently $13.50 an hour. Of that, up to $7.95 can be credited against the minimum wage rate for tipped employees. So let's go back to our example from earlier where I'm employer A and I have an employee named Barry. Barry is currently a tipped employee, And let's say that he makes $50 in tips in his shift today. He works an 8-hour shift and I'm taking a tip credit. So I'm going to pay him the difference between the Massachusetts hourly minimum wage rate and the tip credit rate, which comes out to $5.55 an hour. The first thing that I'm going to do is I'm going to start off with my baseline. So I'm going to multiply the state hourly wage rate, which is $13.50, by the hours that Barry worked for his shift, which comes out to $108 for his shift in gross wages. Next, I'm going to multiply the hourly rate, $5.55, that I'm actually paying Barry by the hours that he worked, which comes out to $44.40 in gross wages. Now, I already know that the hourly rate that I'm paying Barry isn't sufficient to actually pay him the minimum wage for his shift today. So I'm going to add in the amount of tips that he receives from his shift to see if I can meet that $108 amount, or the minimum amount Barry has earned for his shift today. So I add the $44.40, which is Barry's wages that I paid him, to the $50 in tips that he earned. And so far today, Barry has earned $94.40 for his shift. But that's a problem, because even though Barry made $50 in tips, he didn't make enough to cover the amount that he would have made if he was only paid the minimum wage with no tips. So it's now my job as the employer to compensate Barry for the difference. I subtract the $94.40. Oops, sorry, that says 90, but I meant to say 40. From the $108, which would be the minimum wage baseline. And I end up needing to pay Barry an additional $13.60 to his $44.40 in wages for his shift today. There's additional rules and regulations regarding the utilization of a tip credit, but for right now, let's jump over to tip pools, unless there's any questions. All right. So tip pool. A tip pool is an arrangement where tips are pooled among employees and then redistributed among the employees participating in the pool. There's a number of different types of tip pooling arrangements that can span across different types of jobs, different percentages of distribution, and etc. But there are some common elements that surrounding tip pool arrangements that employers should remain cognizant of. One of the biggest issues that I see with regards to a tip pool is that where employers or managers or supervisor or someone acting as a manager in that shift participates in the pool. Federal law and Massachusetts law all expressly forbid employers from participating in tip pool arrangements with their employees. Another important aspect is consent, because employers cannot force employees to participate in a tip pool in Massachusetts. So those are some pretty big items for tip pools. It's also very, very important to be aware of what kind of employee is working. Again, comes back to worker classification. It's important to know, hey, do I have an independent contractor who's trying to participate in a tip pool? Or do I have an employee, and what is that employee working on? Are they currently working in a tipped capacity? Or are they working in a non-tipped capacity? Because those kinds of factors really play into whether or not it's appropriate for that worker to participate in the tip pool at that time. And those are all things that the employer has to be cognizant of. So that was a lot of information today. I know we only have a few minutes left, so what kind of questions would you like to go over?
Kim, I'd love to just ask about the, when you were saying some workers can be tipped and some can't, is there a clear line with 1099 and W-2s or contractors and employees of which ones can be tipped and which can't? So
with regard to who should be tipped, it usually comes down to job duty. And that is usually reflected on the O*net website that will kind of go into details on the different types of duties that pertain to a specific job. So if I'm a waitress and I'm performing certain duties, I might be, performing those duties within capacity. However, let's say that I'm going to go and I'm going to do payroll and I'm no longer in a tip capacity. So when I'm participating in a tip pool, I need to be paid accordingly for the time that I'm participating in the tip pool as a waitress. However, while I'm doing payroll, I should not be participating in the tip pool because I'm not working in a tip capacity anymore.
Got it.
Okay. Any other questions?
Kim, I think I feel like I've read a lot about lawsuits brought against bigger restaurant groups that have been about tip pooling or like forced tip pooling. Could you talk a little bit about like what happens there and what those lawsuits end up being about? I know we're talking a lot about risk management, so I think obviously if you're a much bigger company, there's more risk. But I feel like I read about that in the news, and it's always about tips.
Yes, tips are kind of the hidden gem in terms of financial risk, because no one really, looks at them as closely as they do with wages. But in some cases, they are wages. And when tips are screwed up, it can kind of snowball. So, what's $2 here, $4 there, or what happens when an employee doesn't actually report the tips that they've earned? It leads to huge and bigger problems. That's why it's so important to have that trusting relationship with the employees, to understand, okay, what tips are being reported, what is being earned, what is being contributed to the tip pool, to make sure that those numbers are going to come out accordingly. So again, a lot comes back on that trusting relationship and making sure that you have the accurate numbers. Like I said, it's very, very easy to snowball into having the incorrect numbers, or having a manager who participates in a pool, or just not having all of the numbers when you're calculating the math. So it can get a little crazy there.
Yeah. We have a question about how some restaurants implement a service fee in addition to or in place of tipping. Are there any legal considerations to how that would be used?
That's a great question. So service fee is usually a service charge, and that is different from a tip usually. A lot depends on the jurisdiction that you're looking at. So in Massachusetts, I believe a service charge is distinguished from a tip, and it is something that an employer has to kind of give notification of. So when talking to a customer or something like that, let's use an example real quick. I'm an employer and I want to assess a service charge. So when I'm talking to a customer, let's say they're placing a catering order with me, and I'm going to assess a 5% service charge. And it's going to consist of a lot of different things, gratuities included. So that's something that I have to notify the customer about, so that they have knowledge about, hey, where is my money going? Because ultimately what distinguishes a service charge from a tip is the ability of the customer to decide what the amount is and who it's going to, as a reflection of the services that they've been provided with by the employee. Does that make a little more sense? I might have made it more complex. I'm not sure.
I think that's super helpful. And I think the service fee tip kind of conversation has been really like active and interesting over the last couple of years in particular. We could probably have a webinar just about that if we wanted to, but there are tons of considerations there. And I would just recommend that you talk to folks who have implemented a service fee to hear about how it has gone for them. And I think communicating clearly with your guests and with your staff about what changes are being made and why is always going to be an important part of introducing anything new.
Completely agree. Well, that's everything that I have. So I am happy to talk about more questions as everyone processes this lovely dry material. later on.
Appreciate it, Kim. Thank you so much. And we want to let everyone know that this will be recorded. So we'll share it with you after the fact if you want to rewatch it or share it far and wide with your fellow folks in the industry. We definitely want to thank the City of Boston for being a partner on this series of webinars. There will be more coming up soon. So thank you, as always, to the Mayor's Office for having us. And I think before we go, Roz, do you want to tell everyone how they can stay in touch with Commonwealth Kitchen?
Yeah. So connected to what we were talking about in terms of like all of these tough questions, who should you reach out to? One of the places to reach out is to other food business owners in the industry. And if you're not already connected to a community of food business owners, or even if you are, Commonwealth Kitchen really fosters a community of food business owners around the Boston area. One of the ways that we do that is through a listserv, which is called the Boston Local Food Biz Listserv. And if you're interested in joining that listserv, you can actually reach out to me directly. Just shoot me a note, say, I want to join the listserv. Don't need to say anything more than that, and I'll add you to it. We have around 200 different businesses that all communicate about questions that come up, even things like this. So, and then we will also be in touch about being able to access future webinars geared towards restaurants as well.
And Jen Fagel, our executive director, wants to remind everyone to apply for the Federal Restaurant Resiliency Grant opening on May 3rd. And of course, just email Roz at that address in the chat, and she can share more info with you about that as well. Thank you again to Kim from Toast. If anyone's interested in Toast, you can go to pos.toasttab.com and of course, commonwealthkitchen.org. And thank you, Demarius, for being our host again tonight.
My pleasure. Thank you all, and obviously the attendees. It was great to participate and be involved with this, and I've actually learned some things myself in terms of this today. So thank you all again for everything.
Great. Have a great rest of your evening, everyone, and we hope to see you at the next one.
Thank you.
Thank you. Bye.